Okay, at this time, I'm going to take some questions. Alan.
Thanks very much. Alan Berger from University of South Carolina. I want to, first of all, commend you guys. Really great session. And I'd like to put things in a little bit more context. Banking research is constantly evolving, and this is the cutting edge right now, is this session. So the papers that are doing the best jobs in banking research are the ones that use what we call quasi-natural experiments. They call them shocks, but I like the quasi-natural experiments because we're trying to get closer to the real hard sciences where they do real experiments. They mix two chemicals together and they get a result, and then they can say, well, I know it was because the two chemicals are getting mixed together because that was the thing that I changed. And here we have something we call quasi-natural experiments like oil shocks or law changes or lottery winnings. This is a really good way to go. But I do have two pieces of advice for all of you. One is that there is a growing literature on this. And I didn't hear you guys really referring to that literature, and there's a lot of it now. And make sure you tell us how your papers are contributing to that literature. For example, I'm just picking on you, Carlos, but so there's a paper by Eric Gilgee that basically is the same thing as yours, except he doesn't have the 109. He doesn't have the 109 restriction. So he has oil and gas discoveries, which are like a lottery winning. The homeowners get money, and it's kind of like the same thing. And you need to compare yours to his and explain it. And then the other piece of advice I have for you is the other way in which we're moving the science forward is by relating these things to the real economy. So I didn't see enough of that in these papers. So yes, okay, so we have a shock, and it makes some banks lend more or lend less in another area. What does that do to that local economy? And fortunately, I can actually help you guys out a little bit because there is a special issue of the Journal of Corporate Finance coming out. And if you send me an email, I will send you the lead article that'll give you some of this more context and the literature on this with the quasi-natural experiments and the real economic effects. So I'll help you out with that if you'd like.
Appreciate that. Thanks. Yeah, Mike.
Yeah, hi, Mike Johnson with the Federal Reserve Bank of Atlanta. A question for Rajesh, and I think a comment for Tang. So the question, Rajesh, is anytime there's a natural disaster, the regulatory agencies, whether it's state or federal, encourage the banks to work with their borrowers, which obviously then is going to have an impact on provisions and so on and so forth. So I was wondering if you took that into account, or if you did, if you saw that it made any difference at all. So it kind of gets back to a little bit of a policy question. Does doing that matter? And Tank, my comment is you talked in terms of the transmission of shocks. Another way to think of it is we were fortunate that there were built-in shock absorbers. And I was wondering if you have done, or I guess my suggestion would be to go back and look at oil price shocks in the early 80s, back when we had more of a unit banking environment, and do some compare and contrast around the depth and severity of the economic outcomes between those two events to see whether or not you actually had a transmission of shock or an absorption of shock, and which is a better policy approach.
Does need to respond at all, or?
Yeah, I can respond to your point. Thanks for raising that. We use that to the only extent where when we read the circulars from the FDIC, which says that there is regulatory relief and they encourage banks to work with the customers. The only thing we take that in the current version of the paper is that that's encouraging the banks to lend more. So there is an increase in credit demand. But are there situations where in some cases where the regulators don't issue that sort of a circular? Do you happen to know?
others can speak beyond me, but I think it's pretty much automatic if it's
Okay.
a, FEMA type of event.
Okay. Thank you.
So thanks a lot for this comment, and I think this is an excellent comment. So just from Gary's comments earlier on, I think there is a huge heterogeneities in terms of how banks will respond to it. And one test I can do is to look at the banks that have established prior to the last oil shock and compare to see whether those banks were able to take on some more absorptions compared to the others. And I can certainly do some more tests looking at the unit banking system here. So thanks a lot. Very, very good comments.
I think it's Quad. Is it?
I'm Quan Liu from University of Wisconsin. So I have a question for Chairman Peterson. So I was when I heard that your bank's capital growth more than 100%, that was pretty impressive for me. So I was thinking, from my sort of like bookish point of view, the capital market for small banks are usually sort of very frictional. In other words, it means that it's really difficult to get external capital or issue external capital to outside investors. One example of these frictions could be, like community banks. They don't really have access to, for example, institutional investors, like the big banks do. So my question is, from a practitioner perspective, what's the most common way you raise capital? Is that just you increase your retaining ratio a lot, or you actually go out and find outside investors?
It's primary function of retention of capital. Hasn't pleased our shareholders significantly over the years. But yeah, we've retained. Our merger allowed us to supplement our capital just because of when we came together. We have not looked at outside investors, mostly because there's been concern about dilution. And so that is a real opportunity, I think, for us going forward as we get comfortable with the generational change that's going to be happening anyway, is we might as well look for people that can provide a future growth pattern for our bank. And I won't say anything about UND versus the Badgers when it comes to hockey. Okay?
Thank you.
Yes.
I had a question for Rajesh, and sorry if I missed this. So thinking about natural disasters and then small banks versus large banks, I think is really interesting. Did you consider the role of kind of funding sources? So it seems like small banks, their funding source gets shocked a lot more than large banks. They get their funding from a lot of different, they have their branch networks. They're not as exposed on the supply side as the small banks. So is that something you considered?
We just thought about it, but we don't have in this version. We just started incorporating that in our analysis. Thanks for pointing that out. So in the next version, probably we'll have to do with the difference in the funding. Thank you.
Yes, sir. Craig.
Craig Goodlock, Farmers State Bank in Michigan. And so I found it interesting when the question, observation for you, I guess observation. So when I looked at the chart that you showed with counties that were generating funds from the oil and gas industry, Michigan had none, which surprised me a little bit because we've got several oil fields in the northern Lower Peninsula. And yet when you showed the shock for the transference of risk out into the rest of the country, all of a sudden those counties showed up in Michigan as places where lending was reduced, which led me to say, sure, because the regulators got on the horn and said, we're going to start looking at oil and gas loans harder than we've looked at for a long, long time. And so you better be minding your P's and Q's in your loan portfolio. And so what I would suggest is it'd be interesting to see, as that shock was pushed out, did that really go into other industries, or was it really simply cutting back on oil and gas investments throughout the entire country?
Yeah, so thanks a lot. This is a good comment. I should certainly check that. So one comment I want to make on this exposure measure. So apparently, like in a lot of counties, they have some oil fields. So I basically look at the most, the counties that exposed to the oil shock the most. So basically, the highest percentage of the payrolls coming from the oil industry. So that makes a difference. So that might explain, sometimes why some of the counties in Michigan does not appear on the map. But the comment is well taken, so thanks a lot.
Well, the clock on the back says 2:45, even though we have 1:20 on this clock. So I'm going to give you 1:15 back. Thank you very much.